Well, as we begin the fourth quarter of the year, if you want to look at it in quarters, and of course, it's supposed to be the first quarter of America's fiscal year, but we have a government shutdown since we can't agree on those things. I always want to bring back somebody who I think makes the most amount of sense about what's happening in this economy and how much of this uncertainty can feel certain down the road. It's, of course, Mark Zandi from Moody's Analytics. Mark, good to see you.
Chuck, good to be with you. Thanks for the opportunity.
So I have been describing the economy this way. If you have money, have some savings, and have the ability to invest, this economy is going okay for you. But if you don't, this is a scary economy. I confess that's a simplified way of putting it, but that's what it looks like to me as a layperson. What kind is that? Too simplified of a description, or how would you describe
No, I think that's pretty apt. I think if you're in the top part of the income and wealth distribution, let's say the top third of the distribution, you're doing fine. You got a job, you're getting a pay increase, get a bonus. You own your own home, you own some stocks, and of course stocks are on a tear. And you don't really owe anything. You might have a mortgage, but you probably locked in back during the pandemic, so you've got a 3.5, 4% mortgage rate. So you're making more on your money market account than on you're paying on your mortgage. So yeah, you're sitting pretty. If you're in the bottom 2/3 of the distribution of income, certainly the bottom third, it's a struggle. You probably have a job, but unemployment is starting to notch higher. And you don't want to lose your job because it's getting increasingly hard to find another one. Hiring rates are very low. You really don't own very much. If you're in the middle part of the distribution, you probably own a home, but if you're in the bottom part, you don't. And you owe on credit cards, auto. If you're in the bottom third, you're probably owe on student loan debt. So it is more of a struggle. So I think that way of thinking about the economy and whether it's working for people is very apt. Yes, I agree.
So, it's interesting because this creates sort of, I think, political challenges more now for the Trump administration. The Biden administration, and it was Biden, and I've always thought it was a bit almost because he spent most of his professional life where the economy was judged. A good economy was based on whether there were jobs being created. A bad economy is when there weren't. And I do think Donald Trump looks at a good economy as when the stock market does well. A bad economy is when it doesn't. And ultimately, both ideas miss the, hey, can I afford this economy, right? Can I live in this economy? It's one thing to have a job. Can you afford participating in the economy with your job? It's one thing if the stock market's doing well, but do you have the money to actually benefit from that? So I do see that as political, but let's start with what you have to do, which is trying to forecast, trying to understand what the economy is. There's all these little tea leaves I was reading about the other day that people are pulling back on big home renovations and they're now doing smaller ones. People are pulling back on big trips, so they're doing maybe road trips. That you're starting to see these little signs of a pullback, consumer pullback, and it's not yet reflective anywhere else, not quite reflected in GDP yet. How important are those little indicators to you, and what ones do you look at, especially now that government data has been paused?
Well, yeah, I mean, I pay attention to the anecdotal information in the kind of the little pieces of information here and there that you get from different sources. But I ultimately rely on the data, the aggregate data. I mean, you can get fooled by, the economy is a big elephant, right? And depending on which part of the elephant you touch, you get a very different picture. So that, if I'm in one part of the country or another, that will influence people's thinking. If I'm talking to one industry or another, that influences people's thinking. If I'm in the top part of the distribution of income or the bottom, that influences people's thinking. So I try to be careful not to get caught up too much in the anecdotes and those little straws, as you put it. Look at the aggregate data, and and for me, at the end of the day, it's still about jobs. I mean, are we creating jobs? Are they good paying jobs? Do they pay enough that people can afford to, purchase the things that they need and that they want.
Mhm.
And there it feels like the economy is kind of a struggle, a bit of a struggle, in aggregate. We're not creating many jobs at all. What jobs we are being created are, in very few industries like healthcare. It just doesn't feel like it's working for, a lot of Americans. So we're not in recession. We're growing.
Mhm.
GDP is positive, but it just feels kind of punk. That might be the word to use.
So if we see the general consensus apparently is a 30 to 40% chance of a recession next year.
Yeah.
How should folks interpret a prediction like that?
Well, the most likely scenario is we kind of navigate through without an actual downturn. So the economy produces enough jobs so that unemployment really doesn't take off here. We're okay. It may not be great, but we're okay. But
So kind of like the first, I felt like the economy in 2001, 2002, where it was a mild recession, but we kind of got through it.
yeah, that's right. But
Mhm.
the risks are to the downside, right? I mean,
Okay.
if things turn out different than that economy we just described, it's
Hmm.
going to turn out worse, not better.
Hmm.
Just to give him a little more context, kind of in a typical economy, the probability of recession would be 15%. We tend to have a recession once every 6, 7, 8 years.
So
So,
every year, if there was no,
yeah.
you would say, well, you have to put it at 15%, but that's just because that's the way it is all the time,
That's
almost.
just the so-called unconditional probability. I mean, on
Okay.
average, you get a recession every 7 years, therefore
Right.
it's about 15%. So if you're at 30%, 40%, well,
Okay.
that's on the high side. It's
Right.
not over 50, that I'll take it, but
Hmm.
30, 40 is uncomfortably high. The other way to think about it might be nothing else can go wrong, right? The economy is,
Hmm.
punk, it's vulnerable to anything that might go off the rails here. And it doesn't have to be a big thing. It could be a small thing because the economy is
Hmm.
as vulnerable as it is.
What has been the impact of what feels, because, look, the Doge cuts get a lot of attention, but there's a real pullback on government jobs on the state and local level because there's a lot of federal money is no longer going to state and local, right?
Right.
We had a lot of COVID. It's funny. We lived almost decade and a half. First, the Great Recession sort of triggered federal help for state and local, and then COVID created more help for state and local. And, I look at a California, which is going to struggle for the first time with a budget deficit that they got to figure out. They're going to do something really hard. I think a lot of states, I think there's going to be a lot of sort of chickens coming home to roost in a lot of states who have these constitutional amendments to actually have to balance their budget.
Right.
Um, what is that risk factor of contraction of government workers, and how much could that trigger a recession?
Well, we're certainly seeing a lot of job loss at the federal level. I mean, the
Hmm.
federal number of federal government employees is down about 100,000 since the beginning of the year. So I'm making the numbers up, but rough order of magnitude, we had 3 million federal government workers at the start of the year. We're now at 2.9, and we've probably got another 100K to go.
Now, some people will hear that and say, that doesn't seem like much, 2.8 to 3. I mean, you round it up, it's still 3 million, right? Like, I mean, you know what I mean? Like,
Yeah.
why is that a lot?
Well, in the context of federal government never lays off, it's always a reliable source of jobs historically. It's been around 3 million for as long as I can remember. So losing 100K and losing another 100K in a short period of time, 6, 12 months,
Hmm.
that's meaningful. It's certainly, obviously for the broad DC area and
Yeah, no, regional economy, you could
yeah,
feel it.
right.
Yeah, yeah.
That broad metropolitan area is in a recession. There's no doubt about that.
Hmm.
Now, if you're right, and I think you make a good point that federal government support to state and local, first states and then local governments is now starting to wane, and you saw a tremendous amount of support in the pandemic in
That's how
particular.
a lot of teachers got raises from
Yeah,
that money, right? Like it was
exactly.
just sort of a lot of public officials, cops, firefighters, teachers, the stuff politicians feel good about. Hey, look, we gave our teachers a raise. We gave our cops and firefighters a raise.
Well, a bunch of other states they cut taxes, right? But
And they did that too, right?
and they now that's an issue because they're not
Mhm.
getting that support from the federal government and likely not to going forward. And now they have a diminished tax base, and so that's complicating things for them. So yeah, the state and local, and there are a lot more folks working in state and local government than in the federal government.
Mhm.
And that if that sector is now not adding to payrolls and ultimately starting to reduce payrolls, then that becomes an even bigger deal. So yeah, it's just the labor market is gone flat here. It's not
Mhm.
creating any jobs. The only sector that's creating jobs is healthcare, and everything else is a little bit adding a little bit or reducing a little
Right.
bit. Government is reducing a little bit at this point.
All right, let's talk about AI.
Yeah.
Is AI having an impact on the job market yet?
Yeah, there's some evidence. I mentioned the hiring rate, the fact that if you look at the number of people getting hired relative to the workforce, it's about as low as it gets when you're in the middle of a recession. We're not in recession because businesses aren't laying off, but they're not hiring.
Mm.
And one reason they may not be hiring is related to AI. Businesses are thinking, oh, do I really need to go out and hire those folks because artificial intelligence will be able to empower my existing workforce to do that work, and I
Is
don't
this
need.
an experiment? Like, my sense is businesses are trying to see if they can use AI to replace humans, and then and then if they don't, they'll go and hire. But if they, can, then
Yeah.
this could then exponentially grow.
Yeah, absolutely. Yeah.
Yeah.
And I think, AI has captured the imagination,
Mm.
particularly of the senior leaders, management of many large multinational corporations around the country. In fact, they're selling themselves as AI companies increasingly because stock prices are as high as they are, juiced by the promise of artificial
Right.
intelligence creating all this wealth and generating a lot of economic growth. They are now saying we are AI, therefore we have to make AI work for our businesses, and so they're asking their existing workforce to figure that out. And you're
Mm.
right. I mean, so far, there's some success stories, but there's a lot
Mhm.
of failures as well, and we'll just have to see how this plays out. And some companies will have to backtrack at some point. But I
Yeah.
think ultimately, businesses will figure it out, and new companies, when they form, they're going to optimize around the AI technology, just
Yeah.
like they did the internet. And so it will diffuse throughout the economy, and it will have more of an impact on the labor market going forward, particularly certain occupations and certain industries that are more
Mm.
likely to be affected by the use of AI.
Yeah, politically, I think the fear of AI job displacement, I think is going to be a big issue in 28, but
Mm,
not until 28, right? Like,
yeah.
I don't think we're there yet on that. But is there, all these data center investments, all this money that's going into this AI expansion, it's not creating new jobs, is it?
No.
It's just computer power. And
No, no. So far, it's more about it's not about jobs. It's not creating jobs. It's more about GDP
it's
and
creating
also
wealth. It's not
creating
even
wealth.
creating revenue. It's
That's
just creating
exactly right.
wealth.
Right.
We're really good at manufacturing money right
Yeah.
now.
Well, here's the amazing thing, and this goes back to where we started when we were talking about the folks in the top part of the distribution, the wealth distribution doing well. The value of all U.S. publicly traded stocks is up $10 trillion in 1 year. So it's $67 trillion today. It was
Yeah.
$57 trillion a
It's
year ago. That's
astonishing.
$10 trillion. And of course, if you own stocks, and particularly the AI stocks, you're feeling pretty good. And that's what's kind of driving the economic trend. So the real impact of AI so far, it's not about jobs. It's more about wealth and GDP, and not more. In fact, if anything, it's reduced employment in the tech sector and some of the other sectors that we just talked about.
There's a reason results matter more than promises. Just like there's a reason Morgan and Morgan has become America's largest injury law firm. For the last 35 years, they've recovered $25 billion for more than 500,000 clients. It includes cases where insurance companies offered next to nothing, short of shortchanging, seeing if they could get away with it. And Morgan & Morgan fought back, and they won millions. In Pennsylvania, one client was awarded $26 million. It was a staggering 40 times the amount that the insurance company originally offered. That offer, $650,000, whatever it took to sort of get away without paying. So with more than 1,000 lawyers across the country, Morgan & Morgan knows how to deliver for everyday people. So if you're injured, you're looking for a lawyer, check out forthepeople.com/Toddcast or dial pound 529 on your cell phone. And remember, all law firms are not the same. So give Morgan & Morgan a look. Their fee is free unless they win. So give me some historical parallels. We had this kind of investment in tech in the 90s, turn of the century. We had this kind of investment in the industrial age. We had this kind of investment in the build out of the suburbs after World War II. Is this a bubble? And it certainly looks bubblish. And yet it's amazing to me. Only Jamie Dimon seems to be the only one in that world that seems to be concerned that this could all be a bubble. How would you, is this something you can forecast, or you don't know if it's a bubble until after it pops?
Well, and I'm hearing more voices, kind of variations on that theme, and I think it's appropriate that the stock market, the stock investors in A are kind of getting over their skis. This is real. These companies are juggernauts. They're making massive investments and they're generating a lot of revenue. But that is also generating a lot of euphoria around the prospects that these companies, are generating, and it's driving up their stock price. So you can have a situation, and I think we do, very similar to what happened back in Y2K in the internet bubble and in previous huge periods of technological advance, where investors kind of get ahead of the story. They discount all the good news and then some, and then some. And then once that happens, you get speculation. That's when investors in stocks and other assets buy that stock or that asset simply because they think they can sell it at a higher price down the road. That's it. They're not thinking about, where the value comes from. Will this be more valuable in the future? It's simply the euphoria, the speculation. And I don't know that we're quite there yet, Chuck. That's what I would call a bubble, when you get that kind of speculative fervor. But it feels like that's the direction of travel here, right? And in fact, when I look, like most economists and people in the markets, I'm looking at the stock market 4, 5, 6 times a day. I go see what's going on.
Right.
Usually when I see green on the screen, that means stock prices are up. I feel good. Now I'm feeling, when I see green, I'm getting more nervous about it.
I appreciate you saying that, because so do I. And it's like, look, I'm in that. I'm not quite at thinking about retirement, but
Right.
so I'm still kind of, and at the same time, you're like, geez, I know there's going to be a correction. How massive is it? Like, you just talked about $10 trillion. That means we could lose $5 trillion of wealth,
exactly,
and still be up $5 trillion. But if we lose $5 trillion in wealth in the next 6 months, people are going to panic.
Yeah, exactly. You got it just right. So this might be a little nerdy, but to measure this, to your question, are we in a bubble? The tried and true way of kind of looking at that is the so-called price earnings multiple. Take the stock prices, look at it relative to the earnings of the companies that
I love doing that. Palantir is like 150 times earnings, but like Google is still only 19 times earnings. Like, it's funny.
Your PE. Wow, that's impressive.
Yeah, well, I'm not an economist, but I play one on a podcast
too. Yeah. Well, anyway, so if I look at, I have what I call the economy-wide price earnings multiple. That's the Wilshire 5000. It's the value of all stocks, divided by economy-wide after-tax corporate earnings. So that's the price earnings multiple. On average, since 1916, that's as far back as I can calculate it. I'm making this up roughly, so I'm rounding. It's 10. That's the multiple is 10. 10 times stock prices are 10 times earnings. Right now, today, it's almost 20. There's one other time in that historical period when it's been higher. Y2K, it was 24. So, and of course, we're still going higher here. So, I don't know, the so-called mean reversion. It feels like to me we're overvalued. We're bordering on frothy and speculative. If stock prices continue to rise, then I ring some alarm bells. I do think we're going to see a correction at some point here.
I think what's odd about this is that a lot of folks assume tariffs would slow down the growth of our economy, right? Would certainly hurt traditional companies because of rising costs. and all of those things. And so here we are in this weird environment where tariffs are having some
Yeah,
impact,
right.
certainly on the consumer and certainly on some businesses. But because this AI part is an investment type of thing, it is it tied to the tariff, and in some ways, Trump has sort of compartment, is protected that space from his protectionist policies. So, how would you view the impact of the tariffs? Every time I've noticed this with a lot. Every time we look at it, it's like, yeah, it's coming, but it's not here yet. Yeah, it's
Well,
coming, but it's not here yet.
yeah,
Where are
no,
we now?
the thing is, there's a lot of cross currents here, right? We just talked
Right.
about the tailwind, and that's AI, and that's a
Hmm.
powerful tailwind. All
Hmm.
the data centers, all the investment in the electric power, all the wealth that's being generated, that's driving consumer spending of those folks that own the stocks, the high end net
Hmm.
worth individuals. About half the growth in the economy is just AI, right?
Hmm.
So to give you a number, GDP growth, that's the value of all the things that we produce, is 2% year over year, 2%.
Hmm.
If not for AI, it would be growing 1%. And
Wow.
that's tariffs. And if you're growing 1%, that's not a recession, but that's really uncomfortable.
But you're
And
not
that's
keeping up with
yeah,
your inflation at that point.
yeah. So the tariffs are doing damage to the economy. It's just that the fallout is being masked to a significant degree by this powerful tailwind of AI that's really come into its own over the last 6, 9, 12 months.
So this is it's so look, at some point AI investment plateaus, right? And the
Yeah.
tariffs stick.
Yeah.
So that that's where this is headed, right?
Well, I mean, if the tariffs rise and level off and stop rising, at some point where, the economy
Hmm.
adjusts to that. So, both those things could, kind of offset each other. So increasingly, this is the consensus view, in my view, that it's going to feel uncomfortable at times, but we're going to be able to avoid recession because of that AI tailwind that we're enjoying. But having said that, the economy is soft. The job market is punk. We're not seeing any job growth whatsoever. We are vulnerable to, again, whatever else might not stick to script. And there's
Hmm.
certainly a lot of things that might not stick to script here.
A few. I want to hit two other topics here to sort of understand gold.
Yeah.
Whenever gold, I've sort of in my head, when I see gold go higher, that's bad news for the American economy. It always gets me nervous. Yet this is a case where here, everything's going up, gold too.
Yeah.
That's unusual, no?
It is. I mean, and this goes back to the question of, are we in a bubble and
Hmm.
speculation, and the fact that we're seeing prices rise for all kinds of assets at the same time adds to the concern that this is, broader. A bubble is developing, and gold prices are at record highs. We're over $4,000 an ounce for the first time. Silver prices, obviously crypto prices. Actually, interestingly enough, the only asset for which this is not the case is real estate, right? If you look
Well,
at the
that was going to be my
yeah,
next topic, which
yeah,
is sort of it is that's a strange aspect that people that real estate is not seen as a safe harbor, but gold still is.
yeah. And I think the thing about gold is it's got in each one of these asset classes that we're talking stocks,
Hmm.
commodities like gold and crypto have its own kind of idiosyncratic
Hmm.
aspects to it as well. In the case of gold, it really got a boost when Russia invaded Ukraine and the U.S. Froze Russian reserves. Those are dollar reserves. There are dollar
Hmm.
assets sitting in bank accounts around the world, and the U.S. froze those assets, those dollar assets. And so countries around the world with those dollars assets began to wonder, well, maybe they'll do that to me if they don't like something I'm doing. Therefore, I'm going to diversify away from dollars into, let's say, gold. So
Hmm.
central banks around the world are now, big investors in gold. The other thing is there's some, concerns about the safe haven status of the U.S., right, in the context of the trade and tariff wars and kind of the repositioning of the U.S. in the global economy and the financial system by the Trump administration. I think global investors are asking themselves, is the U.S. really the place you want to go to put your money when times are tough? And if you question that, then you buy something like gold, as a hedge. And then the final potential reason for what's going on in the gold market is inflation. So, there's inflation has been a problem since the pandemic, the Russian war and the impact that had on energy and commodity prices push up inflation even more. And there's a lot of discussion, concern about Fed independence. Is the Federal Reserve going to remain independent going forward? And if not, does that mean the Fed's going to keep rates too low for too long and juice up inflation? And if you're worried about inflation here going down the road here, you're going to buy something like gold. So there's a lot of things coming together there, I think, pushing up demand for that commodity.
What is the risk to our economy if we're not a safe haven?
Well, it means higher interest rates, all else being equal. I mean,
Okay.
especially in most times that's not that big. It's a deal. I mean, we benefit from that, but it's really a big deal when things aren't going well, when the
Mm,
world has a crisis, when we have a pandemic or a global financial crisis or something goes off the rails somewhere. Money comes from all over the world, comes flowing into the United States, and it really cushions the blow of that shock on our economy, and it helps us navigate through, and we kind of lead the way for the
hmm.
rest of the world. That's going to be harder to do if, in fact, investors don't view us as that safe harbor, as that safe haven, and the money doesn't come flowing in the next crisis. And we have to pay more for capital, higher interest rates, and that's certainly a corrosive on our ability to invest and to do all the things that we want to do.
Yeah, I just sort of like, so how do you connect it to the average person? Why should I care if we're not a safe haven? What you're saying is, well, if you like lower interest rates on your credit card debt, if you like a lower interest rate on your
Yeah,
mortgage, this
yeah.
is why you want the rest of the world feeling America is a safe harbor.
Or you're a small business and you need to borrow money to expand your business or hire, or even if you're a large multinational and you need to go out and borrow money to invest in, let's say, those data centers. I mean, it's just going to be a lot more costly to do it. And in most times, this generally going to be more of a corrosive on the economy. It's not like a cliff event. It's not like
Mhm.
all of a sudden you go off a cliff because the safe haven status is under question. It's more of a weight on the economy that over time diminishes the economy's ability to do what we've done historically, and that's kind of lead the global economy.
I don't know if this is sort of outside your field, but how do you assess energy costs? Because it does seem as if that's becoming right. We're seeing rising electricity bills all over the country. Is this how much of this is we haven't diversified our grid enough? How much of this is there's more of these AI companies, more demand on the grid itself, and we're having to do it? And is that easy to assess? And how do you factor that in? Because when energy costs rise, that impacts everybody, right? That's
Yeah.
just a giant sort of slowdown on the economy. And that feels like something that we're not really, it's happening and we haven't really focused on how that could be a real sort of governor on our economic growth.
Yeah, well, if you're talking about electricity, the
Hmm.
cost of electricity, and that's going up just like everything else, demand and supply. On the demand side, all these data centers scarf up a lot of electricity to be able to run the servers and do
Hmm.
the AI calculations. So that's juicing up demand. And on the supply side of the electric power market, it's slow to respond, particularly in the context of policy changes under President Trump, where he's moved away from clean energy, moved away from solar
Just
and
the
wind.
shift itself slows us down, and
Oh,
it doesn't
absolutely.
like I'm not. We're not weighing in on whether Biden's right or Trump's
Yeah,
right. The transition itself slows us down,
absolutely. Now,
and
there's a lot of discussion about going to nuclear, and that's the direction we're going to head here, but that takes time,
that's
right?
a lot of time,
A
right?
lot of time. There's these smaller nuclear facilities that you can get online more quickly, but they're
Hmm.
small. You
Hmm.
need big nuclear plants to be able to generate the power that we need, and that's just going to take time. So I would buckle in here on the that we're going to be
Yeah.
paying more for electricity. The fortunate thing though is oil prices, which obviously we still many people still drive gas
Right.
powered cars, that's down, right? That's 60, $65 a barrel.
So
That's
why, if that's down, why isn't that having some impact on our electric bills? Because
well,
usually when
because
the price of oil goes up, the price of all energy goes up.
well, I mean, no, the electric power is very little of it's oil powered. There's
Right.
natural gas, but
Right.
natural gas prices are relatively low. It's still relatively low
Mhm.
because we produce a lot of natural gas here, and it's hard to export to the rest of the world, although
Right.
we're trying. But most of it is natural gas or renewable
Hmm.
solar, wind, and to a lesser degree, nuclear and coal is becoming less of an issue. But oil is a very, very small piece of the
Gotcha.
what's used to power electric power plants.
Gotcha. So let's talk about real estate. There was an interesting little one of the million newsletters I read every morning. So I'm not going to sit here and tell you I
Those
remember which
threads,
one.
those threads you were
Right.
talking about.
Right. There's
Yeah,
so many of them.
yeah.
But one notice that it's like, so the talking point of why real estate investment has been slow as well, inventory's low. Um, but it's still, one would assume if there are investors looking for safe havens, why are they only going to crypto and gold? Why aren't they going to real estate, which has traditionally been a pretty good inflation buffer?
Well, there's the residential side,
Hmm.
which you mentioned, the single family housing, and then there's the commercial real estate, and that's where
Hmm.
generally investors have gone. It's the CRE, commercial real estate, office properties,
Right.
retail malls, some
It's
apartment buildings.
amazing what the price of some of these beautiful office buildings are going for at the moment.
Yeah,
I mean, if you ever wanted to own an office building,
right.
do they have a deal for you? Right.
Yeah, and I think a couple things happen to commercial real estate. One is interest rates. When interest rates, real estate's very interest rate sensitive, much more
Hmm.
than any other asset. And so when interest rates rose, when the Fed jacked up interest rates to cool things off back, a few years ago in 22 and 23, going into 24, that caused the prices to come down for almost
Hmm.
all CRE. And then each property type had its own kind of story. And you mentioned office. Obviously, there it's remote work, and the demand for
Hmm.
office space, got crushed. But other property types also have their own stories. Like in the multifamily sector, that's not about demand. That's more about supply. That's where builders got
Hmm.
ahead of themselves and put up a lot of these huge luxury apartment towers. And while there's a lot of demand, there was just too much supply, and that's
Hmm.
caused rents and prices to come in. So commercial real estate has kind of operated on its own independent dynamic, and it's been much more affected by the run up in interest rates than the other asset classes. On housing, that's generally there's some investment in single family rental, but mostly that's you and I,
Right.
American households buying those homes.
Hmm.
And the market has struggled in terms of sales because of the so-called interest rate lock.
Right.
Rates were very low back in the pandemic. People got mortgages at 2.5, 3.
I'd love to sell my house, but I don't know what I'd get into.
Yeah,
I mean,
exactly.
no, I mean, that's a real thing. It's like
That's a
you can
real
make
thing,
yeah,
right?
it's like, boy, I don't want to pay that high interest rate in my mortgage. I've got this great low interest rate. Right.
Yeah. So if you have a 3% mortgage and existing mortgage rates now are over 6%, are you really going to make that trade? And the
Hmm.
answer is most people aren't. At least not yet.
So let's stick with housing. What could government do besides lowering interest rates? So let's set interest rates aside. What else could government be doing to just improve the affordability of the housing market?
Yeah, I've done a little bit of work here. I've got a paper out with a few colleagues.
Hmm.
You could Google Zandi affordable housing crisis, and
Well,
you'll get to it.
this is for what it's worth. When you talk to members of Congress and they say,
Yeah,
"What issue do we in the press not bring up enough, but your constituents talk about all the time?" It's this issue.
this one,
Yeah,
right?
yeah.
Yeah, in this paper, what we did, we tried to estimate the balance between supply and demand for housing, both on the rental side and on the
Hmm.
homeownership side at a census tract level. So at a
Hmm.
very
Oh,
detailed
wow.
level of geography. So and it's very interesting. You see, and then we cut the data in lots of different ways, one of which is
Hmm.
around price points,
Hmm.
just different, is it for high-end consumers, kind of workforce or low income? And what we found is no surprise. I just mentioned it at the high end of the rental market, it's oversupplied. You got too many big luxury condo towers in DC and Philly, Chicago, San Francisco, that kind of thing. The
Hmm.
builders got ahead of themselves. Really interestingly, Chuck, at the very lower end of the market, it's not overly undersupplied. It's kind of well balanced, and that's because there's a lot of tax subsidy already provided for
Hmm.
low income rental, like LIHTC, that's low income
Hmm.
housing tax credit. The real shortage is actually for what I call workforce housing, rental, and for home ownership. Those are for kind of teachers and
Hmm.
firemen and kind of middle class people are making 75, 80K a year on a household basis, nationwide. That's where the real shortage is. And so that's where policymakers really have not focused. They've been focused on the low end. They really need to focus on the middle part of the market. And there, I would argue, if we had some tax subsidy like a LIHTC for
Yeah.
workforce rental, that would be very helpful.
Is this so? How sensitive is that issue by wealth of county? Right. So I take a look at, like, you go to in and around San Jose, frankly, in and around DC, right? Montgomery County, Arlington County, where the service industry folks, your teachers, your firefighters, your police officers can't necessarily afford to live in the county that they work in, right? Because the cost of single family homes are so high.
Right.
This is true in and around Silicon Valley. This is true in close in parts of LA and New York, et cetera. It seems like that's a challenge that's very specific. But is this also an issue in and around Louisville, right? In and around Wichita?
Yeah, it's coast to coast, and it's
Okay.
market to market, and even in those very wealthy areas of the country, you can see there are real pockets of shortages in certain segments of the market.
Hmm.
So it is coast to coast, and it's very, very local. It's not that's one of the reasons why it's such a hard thing for policymakers to address. It's not like I can do something at the federal government level,
Hmm.
wave a magic wand and solve the problem. It's really a lot of, trying to understand individual markets at a local level and trying to figure out what the best strategy is to address those. And of course, underlying all of this is zoning and permitting. Of course, the federal government has nothing to say about that and
Hmm.
won't, because the political, ramifications of trying to address that would be, overwhelming. I just don't think it's possible. So it makes it very difficult for the federal government to really address this head on in a grand way. It's got to be done, helping local governments try to figure out, what they need and where they need it, and give them the resources to help them do it.
So in some ways, it's incentivizing local governments to change their
Yeah,
policies. Yeah.
again, I'd go back to, there's LIHTC is low income housing tax credit, much maligned. No one really likes it, but it's tried and true. It's
And it kind of works.
operational,
Right.
kind of works. I take that and run with that and to just kind of tweak it and make it work for workforce rental.
Um, that gets me to something else that I think and maybe this is just a hallmark of the 21st century, but how much would our economy benefit from domestic migration? And is that it seems as if we move less domestically
Yeah,
than we did. Hey, if I can't find a job here, I'm going to travel to another state to go get work, or
right,
I can't afford a house here, I'm going to move somewhere else. And we've seen, there was a little COVID migration. Obviously, Florida experienced that, Miami in particular, but that was kind of high end. And it really has messed with inflation in Miami uniquely.
right.
But I've always thought one of our problems is that and why we are so living in our silos is that we don't have the domestic migration that we actually did have a lot of in the 50s or did have a lot of in the
Right.
30s. Um, is that measurable?
Yeah, yeah, it's an excellent point. We get at Moody's all the credit files in the country every
Hmm.
month, anonymized,
Hmm.
and we can see address changes. So I can tell you exactly how many people are moving from Chicago to Miami and
Hmm.
back in a given month. And you're absolutely right. Over the last few decades, we've become a much less mobile
I use the
society.
U-Haul thing, by the way.
Yeah,
U-Haul, like,
yeah,
I always throws that out, and
yeah.
that's what
I've
a
lived them a
layperson like
while.
me. The U-Haul rental thing is interesting to me, and it
Yeah,
does seem to, yeah.
I should go look at that. I haven't looked at that in a while
Mhm.
because I've been looking at this credit file
You
data.
have better data,
Well, it's
please. I
kind of
don't
cool
get
data.
credit
It's
file
really,
data.
it's, because I am kind of nerdy. I love
Right.
looking at that data. And, you know, one of the reasons why we're not moving as much is because of just we're aging. When you get older, you tend to move less. When you're
Right.
young, you're switching jobs and so forth and
So we're
so on.
just an aging population. That's
Yeah.
one explanation. Okay.
Yeah. And the other is, I think, goes back to the income and wealth distribution. If you're lower income, middle income, and you live in parts of the country that got nailed with the loss of manufacturing,
Hmm.
the economy is just not very dynamic. House prices have not risen at all. They may have actually even declined in some of those communities. You just can't, you can't, and then you've seen the house prices rise where on the coast
So,
and
so
big
you, what
urban
you're saying
areas.
is you can't afford to move. Yeah.
You literally can't afford to move. There's just no
Yeah.
possible way you're going to be able to do that. So you're kind of stuck. Even if you wanted to move to get that to that job that's
Mm.
sitting in Miami or
Right.
wherever it is, you just can't do it. And that's really cut down the mobility. I will say though, that has historically been one of the unique characteristics of the U.S. economy compared to anywhere else in the world. Very few exceptions to that. And it's that mobility that has allowed the U.S. economy to adjust to shocks. Because as you say, if you lose a job over here, you can pick up and move to take a job over there. But that flexibility, it's still there. We're still much more flexible, mobile than, let's say, Europe or
Right.
other parts of Asia, other parts of the world, but much less so. So we're not, we don't benefit to the same degree as we did 30, 40, 50 years ago from that mobility.
All right. Let me get you out of here on this, which is our how much is our economy at risk due to domestic politics, and how much of it is with more global forces?
I'd say all of the above.
Yeah.
But I think it's
Or
clear.
you can't really disentangle the two.
Yeah, I
Right.
mean,
Yeah.
look, I think it's pretty clear that our politics are fractured, and probably goes back to what
Is
I just.
that worth a point of GDP probably?
It
That are
ultimately
that
will
if we had a
be.
better politics or a more functional political system, we probably would have a healthier overall economy.
How can it not be the case? I mean, just take a
Yeah.
look at what's happening now with the government shutdown, right? I
Right.
mean, yeah, there's no upside to that. There's nothing but downside, and it diminishes our
Mark,
long-term
I have
health.
there's nothing in the Constitution that says government has to shut down if there's an appropriations dispute. It drives me crazy that we've just decided collectively this is how we should function, but
Yeah, there you go.
here
And
we are.
and then but of course that this is goes to our ability to respond to the challenges that we
Right.
face, and there are many challenges, both domestic and globally. That what's going on globally, there's tremendous challenges there, and we can't address them if we're as politically fractured as we are. So I think that's yeah, again, I want to say it's not a cliff of I kind of think of it as there are corrosives and there's cliff events.
Right.
This is not a cliff event. It's not like we're going to go
Yeah.
off the cliff here, but it's one of those things that kind of undermines the economy's ability to grow
Yeah.
longer run. And you don't really feel it in a given year, but when you look back over a decade or two, you go, "Oh my gosh!" You can see it, you can see it, and you can feel it.
Well, the reason I asked about the international versus the domestic, I mean, look, I think we all understand the domestic, but I look out of China. Is that a healthy economy or not? If youth unemployment is near 20%, how's
No,
that not? How's that a healthy economy?
no, they got their own. We got their own problems. I mean,
And could that lead to contagion globally? I mean, there's such a big economy. How could it not?
well, uh, I mean, I think it's one of those things where they can keep it together for an extended period, right? I
Because
mean,
of their system of government.
their
Right.
system of government. I mean, it's very autocratic. I don't think it works well in terms of in terms of long-term economic growth, but
Mhm.
they can keep things going for a long time, and paper over a lot of mistakes, and that's what they're doing right now. So I'm not bullish on China long run, but I'm
Mhm.
not bearish in the near term. I don't think that's something that's going to fall apart anytime soon.
All right. So if I have you back here after the 1st of January, you think we're probably going to be in the same levels of risk, more likely than not, just sort of sitting in this same sort of elevated, but not there in a recession.
Yeah, I think that'll be the case, Chuck. I mean, I do think that if we look out a year from now and towards the second half of next year, we might start to see a lift because at that point we're on the other side of the tariffs, the immigration
Hmm.
policy. and you've got lower interest rates. The Fed's going to be cutting interest rates. And, there's a lot of so-called fiscal stimulus in that one big, beautiful bill that got passed. There's a lot of cutting, but that comes later. Next year, it's all
Right.
about the tax cuts. And so people are going to get bigger refund checks.
So you think there could be another in some ways maybe we might have a leaky hot air balloon, but there's going to be more air pumped into it.
That's a great way of putting it. Yeah, that's a great metaphor. It's exactly what's going to happen. So, I think the economy is going to be most vulnerable in the next 6 to 9 months. On the other side of that, then I think it'll get some juice from the fiscal and monetary stimulus that's in train here.
All right. Mark Zandi, always great to hear from you.
Yeah, thanks, Chuck. Thanks for all the wide-ranging questions. Always appreciate it.
Well, you humor me well, and at the same time, you're pretty good about putting this stuff in English. And
there you go. Pretty good, Chuck. Pretty good.
Well, you can't ever say great, right?
Yeah, there you go.
I never give 5 stars, right? I'm a 4.9 guy now.
Yeah, I hear you.
Thanks, Mark. Good to see you.